Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research.
We are celebrating a major milestone, the 300th episode of Investors Hangout. We want you to be a part of this special episode. Share your experience with us, record a short video sharing how Investors Hangout has helped you, and you could be featured in our 300th episode. Share your videos with us on vrhangout@valueresearch.in.
Now, to start today's episode, we've got a very interesting viewer's question. PN Saraugi says, wisdom in general has been sasta kharido, mehnga becho. That's buying low and selling high. But all the while, pundits have been advising not to time the market. Isn't that contradictory? So, Dhiren, what do you have to say to that?
Buying low, selling high is a short way of making money. The only problem is that you can't do it. It's very difficult to do it.
Yeah.
Because when it's going up, it's very difficult to onboard at the peak before it starts falling. It amounts to climbing down before it falls, and getting in again after it has fallen the most. So perfectly timing it or buying at the low and selling at the high and doing it perpetually, regularly with consistency is a very difficult thing. Most fund managers have not been able to do it. But at Value Research, we have a very simple principle that you can't do it perfectly. It's impossible to time the market. The next best thing is invest for the long run. And once you have meaningful money, do some asset allocation. What happens as a result of asset allocation and rebalancing is that you are not doing this, big gymnastics, that you will be entirely, fully invested in equity and you will be completely out of equity. What we are saying is that you will be invested in equity, and once it becomes meaningful, take some money out from your fixed and move it into fixed income. Whether it be 25%, 50%, and that we have talked in this Investor Hangout time and again. That make it 50-50, make it 25-75. And as a result of this, what is happening in the market, what will happen as a result of this is that your 25% into fixed income will suddenly become 35% because equity has gone down in value. And as a result of that, you will get an opportunity to rebalance. So effectively, having an asset allocation and doing a periodic rebalancing means that you will be buying low and you will be selling high.
Okay.
But you will not be doing it in a knee-jerk way. You will not be moving from 0 to 100 and 100 to 0. You will be moving from 35 to 50 and 50 to 65, those kind of movements. So you will be doing it in a very sensible way. And this asset allocation and rebalancing is based on the basic premise that, don't have a balanced approach to things.
All right, with this answer of yours, you've laid a foundation for the episode that will follow now. So when we talk about investing, many of us have broad goals like growing our wealth. Some of us also have very specific targets like, investing for a child's education or for our retirement. But how crucial is it to align our investment with these goals? And why do so many investors end up picking the wrong investment vehicles for this objective?
This is very important. This is very important at the outset when you are, when you are getting started. Simply because, investing is so much about managing your mind. And when you are investing with a goal, you have a very clear orientation. If you are investing for a short-term goal, you should be choosing an appropriate vehicle. If you are investing for a long-term goal, because even retirement or child's education could be long-term. Retirement or child's education could be a medium term. You might retire in next 5 years and your child might be getting into college after 6 months. So anything could be short term, anything could be long term. But once you decide, so choosing the right vehicle is entirely a function of time. And then comes how crucial is that goal. Because whether it is a negotiable one, whether it is a non-negotiable, assuming that you plan to go on a holiday, and there is a little bit of swing in the market and it is postponed by another 6 months or a year or so. So what will happen? You will have regret. But it is not really going to, turn your life upside down. When it comes to retirement, you will retire, and from that day you will have to depend. And if you are going to depend on your investment for regular income, you better be very careful about it. because that will be a huge compromise if it is not very nicely in place. So having a having a goal linked investment plan, or having it at the back of your mind, what part of your money is for long term, what part of your money is medium term, what part of your money is emergency money, you can lay your hands on any time, is very crucial, because that is the only thing which guides you to behaving properly. Otherwise, most people start their investment that they have to make money. And when they stop making money, or suddenly their whole roadmap is disrupted, they run for cover. Because when your goal is to make money, then it is very much understandable that the moment you stop doing it, you should take your money out. But that is not about it. It should be, you should have a game plan, and markets will always be like this. Markets will be very scary on occasion. Many investors have not seen that part of the market. If at all they have seen, they have not experienced it. So you have to really, and it is very difficult to learn from history here. You have to really see the decline and the fall and experience it yourself to really be able to withstand it.
Right. Now you mentioned, aligning our investment with our goals, short term, medium term, long term. What really is long term? It is very subjective. For someone, long term can be 1 year. For someone else, it can be a decade. So what exactly is long term? What do you mean there?
Oh, yeah, there are different definitions. For a day trader, holding your investment for 7 days could be long term. Or taking a delivery could be a long term. Or, for somebody who is thinking in weeks and months, for him 6 months could be long term. Even the government defines as long term capital gains as 1 year. Some other assets, it says 2 years. So 1 year, 2 years is, but I will look at, if I have to think in terms of what is long term for an investor who invests in equity. And that is my modified definition of long term. If you invest in equity, that is the time period in which the likelihood of a negative return is reduced substantially. For that, for a one-time investment, that long term means 9 years. And for your SIP investment, that gets reduced to 5 years. If you are investing month after month, assuming that you have started investing at the peak, based on, and these are based on the Sensex numbers, you end up making money if you do your SIP for 5 years. And assuming that you caught the worst day and you sold it on the worst day, and I am referring to if you bought it in 1992 and you sold it in year 2000 or 2001, that was the 9-year period in which, you were able to break even with a 9-year holding. So, but you have to be very unlucky to pick the worst day of the 4 decades. So, I would say that most investors doing periodic investment should have at least 3 to 5 years time frame when investing in equity by way of SIP, and that is long term. Because long term means which will reduce the pain, which will reduce the possibility of a serious negative return, serious decline in value of your investment. And that is, 3 to 5 years of SIP.
You mentioned that, for long term, one should know for equity, one should be investing for the long term. But if one has to, take the money out in a short term or for medium term, what are the vehicles that one can invest in? I know you've said it again and again, but just to reinstate.
No, if you need the money in any time, put your money in your bank account or move the money to a liquid fund. Liquid funds you can redeem and you can get the money tomorrow morning in your bank account. Even the transaction time for processing a liquid fund is shorter. So, and the likelihood of that going down in value is very low. There's virtually no possibility of they going down in value. So your principal is never at risk. And the advantage is that, you will have, because the primary objective of any investment is that it should not really have a bearing on your sleep. You should be able to sleep well. And by putting your short-term money, the money which you need on any day in the next 5 days, 7 days, 10 days for a crucial goal, that being in equity is a very disastrous thing. It will be fun if the market is going up. And that is where most people are caught on the wrong foot.
Right.
Once it starts going up and market is stable and it's only going up, then people start thinking that it only goes up. And the problem is that market, whenever it falls much faster than the steady rise that you have witnessed. So you will not get an opportunity. By the time you figure out, or you get a sense, you make up your mind that, okay, no, this is going to be a very permanent one, you will end up losing 20% from the peak, and that will be a very lasting, impactful exit for you. That will also scare you, out of the market for a long time.
Right. Since you mentioned this, so what are some of the common errors that you see investors making, that can lead to unnecessary losses? This was one of them. And how can they learn to avoid these?
You can't learn. Every investor should do 3-4 things. One is that they should start with short-term investment in equity.
Okay.
And allocate, 5,000 rupees, 50,000 rupees, depending on the money which he can afford to lose. And try it out himself. Because, any kind of teaching, about money issues, I have this strong feeling that you have to lose your own money for you to actually have a lasting. And this is a worthwhile training. This is a worthwhile experience. You invest 50,000 rupees, make short-term investment, devise any principle, any theory that, okay, you will buy that stock which is being talked about on the TV or whatever, something which hits the newspaper every next morning for some positive news, whatever, there could be any basis to it. Try it out. Whenever you gain, lose, sell it on 5% gain, or devise any formula. Once you do it, you will realize that how difficult it is. Most people have this impression that you just have to do nothing. Just buy something where action is happening and then get out. It's almost like riding a bus for 2 bus stops, and the journey is always good. Do that. Then maybe do some F&O and allocate 25,000 rupees. This will be a leveraged trade. So you will be able to, do a transaction of 1 lakh rupee with an investment of 10,000 rupees or a small position. Do that. And do it for a couple of months till you don't lose all the money. And if at all you make some meaningful money, if you are very lucky and maybe you have the instinct, then, if you intend to continue it for the long run, you should continue only with your profits. If you actually get burned in between, then it's fine. It's a lesson learned. And third thing is that, if you make money and you decide not to continue with this one, then, have fun.
Okay.
Enjoy it. So, my sense is that, there is absolutely no learning in this segment of the market till you try it out. It is a very addictive thing.
The thrill you get from taking risks.
Not only that, in India, the thrill is even more. This is almost like speculation. It's almost like gambling. And all other forms of gambling in this country is delegitimized, is illegal. You will actually be doing a crime if you're doing anything else. But here, this is not a crime. This is a legitimate. In fact, it gets the facade of doing something scientific. It's an intellectual endeavor. So in that sense, somebody must do it and be part of the statistics which SEBI says that 93% of the people lose money, and you be part of it. And the reward that you get as a result of it is, long-term orientation, belief in equity, having a methodical approach. And the first step is to actually unlearn and have it clear in your mind that what it is not which everyone perceives it to be.
Well, that's all we have for you in today's episode. Hope this discussion helps you navigate your financial journey a little more confidently without making these mistakes. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.